Alrighty, folks, time to react to a couple videos here. One is this video. Ray Dalio's back again. Ray Dalio saying cash is still trash, okay? We're going to watch that. We're going to hear what he has to say about the market. Does he think the stock market is going to continue to go lower? I'm going to react to that and kind of give my opinion. Second video I want to react to is this clip here. It says, I'm beginning to get overly concerned about a Fed overreaction, says Jeremy Siegel. So another Jeremy, okay? Not Jeremy Grantham, Jeremy Siegel. Not Jeremy Lefebvre, Jeremy Siegel, okay, who's a pretty big name in the stock market as well. So yeah, I hope you guys enjoy this. Let me know what your opinion is on any of this, and yeah, let's just jump straight in, guys.
The same question of everybody. What do you think? What do you think is going to happen to this crazy economy of ours?
Well,
what do you see happening here?
I think, three major themes that we have to understand, right? The creation of too much debt and too much money, right? Mm-hmm. That in amounts that never existed in our lifetime.
If you never watched a Ray Dalio video, by the way, Ray Dalio, he doesn't go straight into it. He doesn't really give you a yes, no right away. He kind of like goes into his points and then goes from there. So.
But existed many times in the past, in the 1930 to 45 period, number one. So we'll talk about that, I hope. Number two is the internal conflict, populism of the left and the right, and what that is doing both politically, and that, of course, have economic considerations. And number three is the rising of great powers to challenge the existing great power and the existing world order. Now, if you bring those things down, here we are having a monetary policy. Okay, where are we in the monetary policy? And what's the big question? So if you want me to answer that, I'll give you.
So I think that big question is, can the Fed effectively reduce demand without breaking the back of the economy?
Soft landing.
And rather than just jumping to the answer, I always like to deal with the mechanics behind the answer, you know? And I think the answer is no, but here's the reason why.
Oh, okay. So right off the bat, he says, no, the Fed cannot basically engineer the soft landing that is, they're trying to do essentially. So let's hear what his reasoning is here.
An interest rate, when there's a lot of debt, one man's debts are another man's financial assets. Mm-hmm. And they have to balance both of those things. And so they will not be able to raise interest rates to a high enough level to adequately provide a real return to investors. So if you think about the rise in rates, mm-hmm. and we say 3% is an interest rate, right, or even 4% in an interest rate, that is not going to be an amount of money that's adequate to compensate for the inflation rate. And we're in a paradigm shift, I think. A paradigm is, something happens for 10 years, an environment for 10 years, and at the end of that 10 years, people believe everything that happened in the prior 10 years, and then they get a surprise. Right. And then they start to change. And something like, for example, cash is a safe investment, or bonds are a safe investment after a 40-year bull market and those types of things. That begins to shift as they start to think, am I getting a real return? So there's going to be a supply-demand balance. Most importantly, the Federal Reserve is going to sell, individuals are selling, foreigners are selling, and the U.S. government is selling because it has to fund its deficit. So there's going to be a supply-demand problem. That means that it produces a squeeze because so much money was put out at such cheap rates, right, and so much financing was taken that it'll be difficult to achieve that balance.
So
yeah, I remember, and that goes back to kind of the liquidity problem we've had in the stock market recently. If you're wondering how so many of these stocks have fallen 70, 80, 90%, it is not just the mere fact that an earnings period was missed, or we have recession fears or inflation high. When you talk about 70%, 80%, 90% type drops in stocks, right, and even some huge companies like that, PayPal's and Shopify's and companies like that, right? You look at how far Meta's fell. Look at how far Amazon's fallen, right? When you're even talking about stocks like that, you have a liquidity problem, and it's just far too many people are selling. There's not enough buying pressure on the other side, and so stocks just drop and drop and drop because every single day, or it seems like at least, right, for at least the last 7 months or so, there's just that overwhelming amount of selling pressure. Day in and day out, in the buyers, there's just not enough buying pressure on the other side. And so a stock price goes lower and lower and lower and lower, right? Then you add on algorithms and those sorts of things on top of that, and that just adds a very volatile mess. And that's how you see these stocks sell off. And you see something like Target, right? Target last week falls 25% a day. That's Target. Like, there's no reason Target should be falling 25% in a day, regardless of they missed numbers and this and that, right? They also hit some numbers. 25%, that was their biggest drop since 1987. We have a liquidity problem in the stock market. It might not be ending anytime soon when it comes to the liquidity problem, but that's basically what Ray Dalio's hitting at there is the liquidity problem, and you have everybody essentially selling at once, right?
When you would tell us that cash is trash.
Yeah.
Is cash still trash?
Of course cash is still trash. Cash, I'm asking you, is your interest, you know how fast you're losing buying power in cash?
I feel that in terms of inflation every day. However, I'm also, for those who own equities out there, they're feeling it even worse.
Well, it depends what cash is. Equities are trashier. Okay. The question is, what's going to get you a real return, right? And so we've shifted it into an environment where assets that do well, almost like in the 70s, are in those types of things. Real assets, real return assets in its various ways are the best investments. I think the world is long. Here's the dynamic I think that's a problem. Everybody's long, equities and so on. And everybody wants everything to go up. And the Federal Reserve wants everything to go up. So what they do is they give you money and credit, lots of money and credit, that helps hyping it. And when the more they hype it, the more it becomes somebody else's financial asset they're holding.
Yep.
And so the world is holding all these financial assets and so on. You can't have that. So you're going to have an environment, I think, of negative real returns. And so as you think about how do you diversify your portfolio or even be short those things, everything can't go up all the time. That system won't work that way.
Yeah, so, we'll react to this Jeremy Siegel one, which I think is very important here in just a moment. But in terms of Ray Dalio saying cash is trash, yeah, I understand what he was saying. Like, as a consumer, cash is trash, right? But at the same time, don't all of us wish we had more cash right now? Because we're looking at stock prices that have been devastated, right? And we all wish we had more money to put in the market. We all wish we had more cash right now, because if we had more cash, we could buy more Amazon shares at 2,000, and we could buy more, if you want to buy Tesla at 600, or more Shopify at 300, Netflix at $100 something a share, or Tattoo Chef or Honest or whatever stock you're buying out there, right? We all wish we had more money, including myself. And so as a consumer, cash is trash, but as an investor right now, cash looks like a beautiful, beautiful thing. We all wish we had more of it around right now. That's just the facts, okay? And so, but I do understand kind of the points Ray Dalio is making there. And it sounds to me like Ray Dalio thinks we have definitely more pain ahead over, he didn't put a timeline on it, but definitely sounds like he thinks we have more pain ahead over this next 6 to 12 month span, okay? So before we get into the Jeremy Siegel, I want to give FTX US a shout out here. Thank you, FTX US, for sponsoring today's video. As always, FTX US has among the cheapest fees out there from any company that possibly competes in the crypto exchange space. If you might know them from Steph Curry, the Miami Heat Arena, Tom Brady, folks like that, Jeremy Lefebvre. It is the crypto exchange I personally use for any moves out there in the market. And right now, they're doing something pretty awesome, which is you can get up to $100 in free crypto when you create an account through my pinned comment down there. Use referral code HOLYSMOKAS and start trading through there and get some free crypto. It's pretty awesome. Also, on all trades over $10, you get free crypto as well, which is amazing. And you can set up your account easily to do recurring buys. Let's say you want to buy like $10, $15 of like Bitcoin, Ethereum, whatever your favorite crypto is that you believe in over the next 5-10 years. You can set up your account to do recurring buys, which is pretty amazing as well. So if that's a limited time offer, so definitely take advantage of that before they end it. That will be the pinned comment down there. And once again, don't forget to use my referral code HOLYSMOKAS. Alrighty, let's get into this Jeremy Siegel one here. Alrighty.
Sir Jeremy Siegel, he is back with us today from Philadelphia. Professor, welcome back to Overtime. It is nice to see you.
Nice to see you, Scott.
I do feel like we had an old-fashioned tug-of-war here, especially going into the close. Those who want to take the market higher, even if it's a bear market bounce, and those who say we haven't gone down hard and fast enough to really justify where we are.
Yeah, well, the first 3.5-4 months of this year, the decline was because of the rise in interest rates. The recent weakness is what I call the numerator, and that is earnings, because in the price of stocks is earnings over interest rates. And, we've had that rise.
Okay, I'm going to stop him right there because he makes a great point. I got to give him that right off the bat there. The issue we had at first was valuations, right? It's like, hey, Shopify stock is too high, it needs to come down. Hey, Netflix stock is too high, it needs to come down. Hey, whatever stock is too high, it needs to come down. At first, we had valuation concerns. But let's make it very clear. Now we have a new problem, which is earnings. Because all of a sudden now all these companies are missing EPS, they're missing margin, their guidance is weak. So now we have more than just valuation concerns. So I think he brings a great point there. And, it's like we went from valuation concerns to now all of a sudden we got actual earnings concerns. And that's a whole different dynamic. And it's actually a more vicious dynamic.
From the Fed, and now there is, for the first time, concern about that earnings. And by the way, earlier today, I look at the money supply as a very important indicator. We had, at 1 o'clock announcement today, the second largest monthly decline in the money supply in more than 60 years. Wow. You talk.
What? In 60 years? Let me rewind that. What? The biggest decline in the money supply in 60 years? That just goes back to the liquidity situation. What?
Earlier today, I look at the money supply as a very important indicator. We had, at 1 o'clock announcement today, the second largest monthly decline in the money supply in more than 60 years. Wow. You talk about contraction. I mean, the big mistake of the Fed was 2020 when they pushed too much money in 2021. We don't want to make too much of a mistake. Are they going to try to just take it all away in 2022? I'm beginning to get a bit concerned about overreaction. And maybe some of the weakness we see in the economy is because, the Fed is withdrawing liquidity perhaps a bit too quickly. I think they could go.
Thank you for somebody else that also believes the same thing I believe in. The Fed way overshot this thing way too far, pumping the money out there, obviously, right? And they created this inflationary environment that, they just lagged so big. It's so big. And now they're lagging way on the other side. The economy is starting to get devastated. We're starting to have company earnings fall apart. Inventories climb. It's getting messier, and it's probably going to continue to get messier. Meanwhile, the Fed is like so hell-bent on we're going to keep raising rates. And, inflation is going to come down no matter whether they raise rates or don't raise. They could keep rates the exact same, and I guarantee you inflation is falling off a cliff over the next 6 to 12 months, regardless if they raise rates. If they just kept rates the same, there's nothing the Fed can do, that essentially all they're going to do is make things worse and worse and worse in the actual economy with earnings and job losses will start coming. Meanwhile, the Fed's so hell-bent on raising rates and sucking out liquidity out of the system that they're going to create this very vicious dynamic that's already starting to play out. And so clearly I'm not the only one concerned about this. Jeremy Siegel is in a major way, right?
Right. So you've been the loudest person on the network over the last couple of months saying the Fed needs to do more. Now you're telling me they're doing too much. They just got started.
I know. Well, first of all, their talk of what they're going to do, we've seen how that has tightened the markets. Bringing in the long bond over 3, bringing mortgage rates over 5%. I mean, you saw home sales today, Scott. I mean, you take a look at some of these monthly reports. I mean, SNAP, is that a warning? Is what we're seeing from the retail is a warning? Now, listen, they definitely have to move up 50. But their July meeting, and I would just recommend that they, if they would look.
Mortgage rates right now are 5.5. That is about, that's average, 5.5 on a 30-year. That's about double what it was, 6 months ago or so. Double, just like that, in a snap of fingers. And so, the way the Fed's going, the way the 10-year is going, I mean, it's very, very possible that when it comes to mortgage rates, average could be 6-7% by this summer. Real estate's donezo. That's all I'll say about that. Real estate is donezo for the next 6 months.
The money supply, they wouldn't be in the position they are today back in 2020 and 2021. Are they going to say, we're going to get the money supply all the way back down? You are for sure going to have a recession, and a bad one, in 2023. My feeling is that maybe there's a lot of inflation in the pipeline. Listen, they can't do a lot about it. That's all really because of the liquidity they put in. It's not like steering a wheel in a car. Oh, well, just turn this lever, inflation goes down to 2%. No. Maybe they should accept the inflation in the pipeline, go easier, get us back down to the 2 to 3% long term that they want. But right now, as I said, I mean, that was a pretty shocking statistic for me because, I based all my inflation forecasts 2 years ago and a year ago on this money supply. I had never thought that I was going to see a decline.
And I mean, what we're seeing is money suck out of everything right now. Buyers of homes are drying up like nobody's business over the last 30 to 45 days, and we haven't seen anything yet. It's going to get much worse over the next few months. We obviously see money sucked out of crypto like nobody's business over the last 6 to 9 months. Money's been sucked out of the stock market in this massive way, just like a vacuum, right? VC space, venture capital, is a mess, guys. That's likely getting worse over the next 6 to 12 months. So it's almost like this vacuum just sucked all the money out of the system and like, what happened? What happened? And real estate's the next thing to start falling in a major, major way. And it's just like, oh my gosh, okay. And so what Jeremy Siegel is describing here is exactly what's playing out.
So pulling money out of the system at the same time that the economy may be weakening faster than people initially thought. You mentioned the home sales report. I mean, manufacturing miss, services miss, composite PMI miss, Richmond miss, your new home sales miss, month over month miss. But let me read you this. This from Bill Ackman today on Twitter, Professor, in terms of what he thinks would stop what he calls the market spiral. What would end it? It ends, he says, quote, when the Fed puts a line in the sand on inflation and says it will do whatever it takes, and then demonstrates it is serious by immediately raising rates to neutral and committing to continue to raise rates until the inflation genie is back in the bottle. Stocks of real businesses are cheap once again. Markets will soar once investors can be confident that the days of runaway inflation are over. Let's hope the Fed gets it right. I hear you saying to people like Bill Ackman, that is way too much from the Fed.
Yeah, let me throw my 2 cents in here. I think, if he thinks the market soars on that, it's just, no, that's just not happening. If anything, that would cause the market to be even more scared. If they just raise rates like crazy right now, things are already weakening in such a big way that if the Fed just puts a line in the sand, no way. Okay, no way.
You're worried that they're going to overdo it.
Well, I'm just saying that they got to keep their eyes on two things. The one is the interest rate, and the other is the supply of liquidity. Don't forget, we moved from unbelievable fiscal stimulus to a situation, biggest one-year reduction that we had since World War II in the budget deficit. There's no stimulus coming from anywhere with restriction. There's the question. A lot of that inflation is in the pipeline. You want to absolutely crush the economy to get rid of it right away, or say, I'm going to let some of it just move through in my thought of getting back to the path. The past mistakes of the Fed, we're paying for those, and the only way they can fix it, immediately is to cause an extremely severe recession. My feeling is, listen, I've been saying go to neutral.
The key word he just used is extremely severe recession. Extremely severe, he just said.
That they've been too slow. I'm just saying they've got to look at money as well as interest rates. They never talked about money. Had they talked about money in 2021, we would not be in this situation today.
So what the Fed's essentially done here, I'll put it like this, a simple analogy is, let's imagine you had a walk through the desert, right? And it took you a month. And you had a certain amount of water with you, I don't know, 5 gallons or whatever, right? And you decide you're going to drink all your water, right? 5 gallons or 10 gallons or whatever you got to try to make it that 30 days to go through the desert. You decide you're going to drink all the water in like the first 2 days, right? Or the first few days. And meanwhile, all of a sudden, like 2 days later, 3 days later, you're like, I would love some water right now. And next thing you know, you dehydrate and die because you don't have any water because you drank it all in the first few days, right? And so that's essentially what the Fed's done here, where they pumped just ridiculous amounts of money out there. Now they're like a vacuum cleaner sucking it all out of the system. And when money's sucked out of the system at the rate it's going right now, I mean, it'll kill the entire economy. And so it looks like they're going to have played it wrong, both sides, unfortunately. And that sucks, because what's going to end up happening is it's not just, stocks go down, crypto goes down, real estate goes down. It ends up leading to job losses. It'll end up leading to layoffs. It'll end up leading to people making way less money. It'll end up leading to the R word, recession. And that's unfortunate, because, they just have gone way too crazy on both sides. And, it is what it is. But yeah, nonetheless, as far as me personally, you guys know, I buy stocks, if stocks are down huge, I buy them. So that's what I stay focused on. But there's no question that economically, we got a messy situation. Earnings wise, we got a messy situation. So I'd love to hear your guys' opinion on what Ray Dalio said there, what Jeremy Siegel said, any opinion on what I said here. Love to, read comments. Much love as always. And also, make sure you get the deal from FTX US. That is pinned comment down there. And once again, use referral code Holy Smokas. Much love and have a great day.